down. On the top of that list is real estate, and kudos to Dan, by the way, who I think in the spring, if memory serves, when Blackstone was like 120, Jay-Z was here. Not that Jay-Z.
Joe Zeidel.
Yes, of Blackstone. Dan pushed back on him in terms of exactly what we're seeing now in terms of real estate and how can you be bullish in real estate in this environment. Now it's all coming to fruition. In terms of the stock, though, you have to ask yourself, is this news going to sort of signal a short-term bottom? I think it actually may.
Oh, Dan.
I mean, listen, just looking at the stock, I mean, it took off. I mean, from 65, that was the pre-pandemic high. It was probably in late 2020 when a lot of stocks did after we had the election, after we had the vaccine news, and it went from 65 to like 150 in a straight line. I mean, this is, again, a financial company that, you know, is, I mean, it just made no sense, right? And we've seen this again and again. So just for me, the trader hat, I'm too dumb to understand most of their businesses. But when Joe Zeidel was on here, he was talking the Blackstone book, but he wasn't really paying much service to the fact that with rates going higher, what it means for some of their key businesses, and that's what we did. So I suspect the stock will round trip back to 65, and so it's not that far away at this point.
I mean, we've talked again and again about what got inflated, what sort of benefited from free money, basically. And this is a major beneficiary of free money. The ability to buy up all this real estate at 0% interest rates effectively. We start to reverse that, and we're seeing the other side of that at this point.
Yeah, I mean, I think calling this the canary in the coal mine is a little silly. It's the ostrich in the coal mine, right? We know that this has been going on for a long time. We've seen
I got a visual on that, by the way.
Right.
Got a visual.
It's crowded, right?
I mean, I'm tall. I like ostriches. I mean, I kind of look like one, so it's okay. But I think, look, we've known that this impact of free money has got to have some kind of catastrophic impact, and I think we're seeing that unwinding throughout the sectors. Blackstone, obviously, but there's multiple sectors that have benefited from it. It's going to spread to tech probably as well.
Well, I think there's a combination of things going on here, and retail pressure in the REIT space has already been there. And if you look at just look at utilities, look at things that have been yield instruments, and these are terrible charts, folks. And let's get back to why people are investing in REITs. I don't think a lot of that has changed, despite what's going on with interest rates and the volatility and the pressure on real estate assets. If you think about low volatility, fixed rate returns, the dynamics here, and if you think about the run on these assets, this is not, this is not what's going on with CMOs and where we were back in 2008. But I do think you have a case here where these are illiquid assets. And often, look, hedge funds will tell you that we're actually protecting you from yourself by putting a gate up because, in fact, we want to limit the amount of volatility in a portfolio. And so that's really what's going on. By the way, this isn't just Blackstone. This is Starwood. This is CBRE. This is BlackRock. And these are some of the biggest funds in the world, especially for wealthy and high net worth individuals.
The underlying message, though, guys, that there's little faith in terms of the bounce back or any bounce back in the office space market, in the commercial real estate market. There's not little faith that rents will continue to rise at this rate. And so that's why people want their money back. They don't have that faith in the markets. That to me is a huge signal that people are not confident in this economy whatsoever.
We're coming up to the 3-year mark of COVID and COVID lockdowns. Think about that, 3 years later. People have gotten used to working the way they're working. Why should there be any faith that things will get even to some semblance of back to normal? So people are going to sell first, ask questions later, because if things do turn around, there's going to be ample time to get back in these names, and that's what we're seeing right now.
Yeah, let's get more on this situation at Blackstone with David Faber, who joins us here on set. I mean, this is CNBC royalty.
No. It's like
that's money.
He's on the, what's that big thing with the rocks with the people's heads?
The Mount Rushmore.
He's in it of the CNBC.
Thanks, guys.
This better be good stuff, Jim.
I'm going to go now. I was just walking around the rain in Midtown and Sandy called, and I'm like, sure, I'm available. Whatever you need.
So how concerning should this be?
You know, I don't know that it's overly concerning. It's not as though there's something nefarious going on at Blackstone, but it's interesting. You talked about the low rate environment, of course, benefiting the purchase of real estate, but it also benefited the enormous acquisition of assets from people looking for yield. And you guys have mentioned this. You talked about the RIAs who were selling this product as a high-yielding product in a zero-rate environment, right? 4 or 5%. Maybe you get some asset appreciation as well. And we were following it. I've been following it for the last year and a half because of the enormous growth. It's been around for 6 years, but it was taking in billions a month. And obviously, many investors were looking at Blackstone, looking at the stock and saying, well, you're taking 1.25% off the top of this thing. If you get to $100 billion in assets, and by the way, they were at 70 billion most recently, you're talking about over $1 billion in fee-related income every year. So this is going to hit earnings. What's interesting, Melissa, as well is their NAV has been higher than the comps. If you look at the publicly traded REITs where they've been valuing things, has been higher. They do it every month. They do the NAV, and they will again, but the expectation is things are going to start to come down. And so those people who were able to get the NAV as it was printed for October, they did well. So many of them wanted out that they hit the 5% limit for the quarter or the 2.5% limit, 2.7% limit for the month. And so they've been gated, but they will keep trying to get people out as they can, meeting those redemptions.
Yeah, no surprise. Blackstone had a statement, and the spokesperson said that they have ample liquidity. They said something like $8 billion in accessible capital. Part of that was floating rate loans. And I was wondering what your take on that. When I hear floating rate in a rising rate environment, that to me is a red flag. But how should we think about
It's
that?
not clear to me that they're going to have any real liquidity concerns in the sense of meeting the redemptions as is under the agreement. In other words, up to 5% a quarter. I think you do have to also watch their selling of assets. They did a big deal last week. It's obviously not going to close for a while, that Vici MGM Grand deal. That will take in some money. They will continue to sell some of these assets. It's a lot of rental properties. It's a lot of industrial assets. That, you know, they know what they're doing in real estate, but it doesn't mean they're immune to the marketplace at this point. And so we'll have to wait and see, Guy, what the next marks are in this portfolio.
Yeah, it's interesting, but does it have any ramifications for the broader market? I mean, Blackstone put a lot of eggs in this basket without question. For 18 months, it paid off extraordinarily handsomely. I mean, does this now manifest itself in other asset classes? Because to me, this potentially sort of tip of the iceberg type of stuff in terms of what Mel just said. Cheap money, people getting out on the risk curve, making bets maybe they shouldn't have made. Thoughts on that?
Yeah, I mean, I'll leave it to you guys to sort of, in terms of the market implications. Certainly there are investors and those who are perhaps even on top of things more closely, and the RRAs who are as well, who say, hey, this is an opportunity for us to get out with the capital appreciation, and we've been doing well, and redeploy, and obviously what is only 9 months later or whatever it is from where we started, a much higher rate environment. Yes, S-REIT, the Starwood REIT, any number of others where you were getting sort of what was promised as a fairly high rate in what was a low rate environment, I think you have to keep an eye on. But the broader implications, I'll leave it to you guys to sort of tell me, because I think it's a good question to be asking, but I don't really know at this point whether it's going to have those.
When I think about other REITs having to do similar things because of redemptions in terms of selling properties, it seems like that would be a major pressure on the commercial real estate market. All of a sudden, you've got a lot of sellers of these assets in a rate environment which is not conducive to sales. I would imagine that would put pressure on prices overall. I know you're not a commercial real estate expert, but
no, but that is a key question. And a lot of since I started reporting on this, I was many real estate investors have been interested, and I would get emails from people who are in that business because they are, first of all, they were a voracious buyer, Blackstone, of assets, and so they were always, you know, bid number one potentially. And if you were a seller in that period, you were happy that Blackstone was there. And it works the other way. So they did well on the sale that they did last week. They have a lot of assets that they bought well, but certainly there is going to be potentially some pressure on prices as a result of them needing to create more liquidity. Again, this is not.
They're not a forced seller.
Thank you.
Yeah.
They're really not. And if you think, I mean,
the gates really prevent that, right? I mean,
Exactly.
the gates prevent that from
And it's not
happening.
as though they put them in just last week. They existed.
Right.
It was always, that's what you were signing up for. But of course, during the period where they were taking in assets very quickly and where you were getting a 5%, let's call it, return, where there was nothing to get in the treasury market, nobody was thinking about that.
Yeah, and I was going to say, you know, the return from inception is over 13% in this fund, but they have $1.4 billion in cash as of November 11th or 12th. There's a credit facility of almost $8 billion.
Right.
So I just want to reiterate, not a forced seller. I think there's some good news here too. If you think about the inflation prospects of the biggest inputs in inflation are owner equivalent rent and rental properties, and this is certainly going to be helping the inflation story. To be clear, I mean, when you think about commercial real estate and you think about the feed through,
good news.
it absolutely is. And I just think, again, for Blackstone, as David pointed out, this has been a juggernaut in terms of an earnings profile and what this has meant. I think the biggest issue right here is a weigh on earnings. And I think that's where you're going to start to see downgrades on Blackstone.
Yeah, I mean, there's a stock-specific story, and then there's the whole this is great news if you want the Fed to stop, right?
Yeah, well, I mean, stock-specific story. I mean, listen, consensus estimates for earnings and sales for next year are basically flat, and then they're expected in 2024 to move up like double digits, maybe in the mid to high teens. You think of this, dividend yield at 4.5%. The lower it goes, the fatter that gets. And again, David just said the balance sheet's in good shape here. It's not a forced selling situation or whatever. So when you think about it from an individual security standpoint, at some point in early 2023, this stock is going to be an unusual value. We spent a lot of time earlier this year talking about some of the moves that they made in the insurance, and that is likely to play off very nicely. I'm just curious, any thoughts how those two barbell, this economy that we've seen, low rate environment, high rate environment now, I think what they're doing in insurance really sets up well for the next 5 to 10 years.
Yeah, I mean, insurance has become an area since Apollo obviously became in many ways an insurance company of interest in private equity, or let's call it alternative asset management for sure. I'll keep an eye on it like you will. I will say, listen, this is an asset gathering juggernaut, the likes of which we've rarely seen in terms of Blackstone. But that's going to slow. We know it. Obviously in the BREIT product, which has been one of the key engines it is. And we'll have to see in other areas as well. Investors now have opportunities that go far beyond, having to look for a higher yielding investment in fixed income or credit that existed previously, where you were taking more risk, or obviously can look as not necessarily at the equity market, but simply at corporate bond returns, things like that.
David, it is a pleasure to have you here. We hope you'll
This was so nice.
stop by again sometime.
It's great for you guys to focus on Blackstone for a while. We rarely talk about that company in the morning. It's a $100 billion plus market cap. I'm glad you guys spent time on it. It's interesting.
Thanks for coming by, David. Always a pleasure. David Faber of the Mount Rushmore of CNBC.